you very much, Sam, and welcome to all of you. It's about that time of year. It is January. It is time to do taxes, and people are starting to think, is this the year that I should start saving for retirement? So you may find that more and more people are coming in and looking at the options of IRAs at a bank versus, say, maybe an investment company. We know that our rates are not the best at the banks, and of course then you have the market, which is very volatile and goes up and down. So what you find is that a lot of people kind of split the difference and diversify, and they may have some of their retirement assets on the investment side, and they may want to keep some guaranteed interest rate assets on the bank side. It doesn't matter which side you have your IRAs on, whether it's investment or insurance companies or banks or credit unions, because it's the fact of the matter is they all have to have the same forms, and we use the same terminology. Now, depending on which forms vendor you use, sometimes they have different names for forms. But the way I like to cover this on the basic class, what I'm trying to do in this limited 2 hours that we have is to just make you a little bit more comfortable. I call it getting rid of the deer in the headlights look when somebody comes in and mentions those three scary letters, IRA, which somebody in Texas told me stands for I run away when somebody mentions IRA, because I don't know anything about them and I'm so afraid they're going to ask me a question. So I start with the terminology. What are the most common terms of IRAs? And a lot of people mess up the terminology on IRAs, and it can create a big confusion. So I'm just going to give you the top five terms of IRAs just to explain the difference and what it really means. Now, there are some penalties associated with IRAs. If you take money out too soon, if you don't take it out soon enough, if you put too much money in. So I'll just cover the penalties, which, by the way, we are not responsible for collecting. It's between the customer and their tax person and the IRS. Well, when somebody does make a contribution to an IRA or does take a distribution from an IRA, how does the IRS know that activity has occurred? What two forms do we send to the IRS every year to report contributions and fair market value and distributions to the IRS? I'll do a quick review of the forms needed to open an IRA, and some of us are doing way too much work than we need to be doing. And it goes back to the terminology of what the actual IRA plan is versus what an account is. And sometimes when we're opening new accounts for existing customers, we're actually doing plans for them every time. And, you know, I've had people say to me, oh, I hate IRAs. Every time somebody wants to do anything, it's 20 pieces of paper. And I said, oh, you must be talking about new customers. Oh, no, existing customers. Every time they make a contribution, we got to print out 20 pieces of paper. I'm like, are you crazy? Who told you to do it that way? I don't blame you for not liking IRAs if you're doing more work than you need to do. So I'm going to, again, I have a nice little cheat sheet because I am the queen of cheat sheets. I do IRA training in about 20 states. I've been involved in IRAs over 25 years. I'm a former banker that started when I was 16 years old in banking. So when I say I'm the queen of cheat sheets, it means that I put quick reference charts in here because being a former banker, I didn't like if somebody asked me a question that I had to read 7 pages of some book to tell them what the answers are. So you'll see some quick reference material throughout here. Then we'll go into the products. The regular traditional IRA that's been around for 40 years now, and we're still trying to figure out what it is. The newer kid on the block, the Roth IRA, I say it's new, it's now 16 years old, but this has been one of the most misunderstood products of IRAs. Even tax people occasionally have given wrong information on Roth IRAs, on who can put it in, when you can take it out, when is it taxable, when is it penalized. So I'll go ahead and clarify that. Also, we talk about if somebody is doing a conversion from a traditional to a Roth, how does it need to be reported? And then we also talk about SEP IRAs, Simplified Employee Pension Plans. And a lot of you say, well, we can cut out early because we don't do those. Every bank used to do SEP IRAs when they first came out, and that was back in 1978. All they are is I call them traditional IRA on steroids. It's the same forms, it's the same amount of work for a lot more money. So I don't think you should be afraid of them, and that's why I kind of discuss them as a plan type in this. So based on that, we'll go to the next slide, which is getting into the terminology. And again, please feel free to type in any questions that come along, and I'll answer them, as many as I can. One of the complaints I get about webinars is, oh, they're just not interactive. They're as interactive as you want them to be. So if you want to ask those questions, I have no problem answering them. I love answering questions because that means you're kind of interested in and you're trying to find out a clarification. So what is an IRA? What does it stand for? It stands for Individual Retirement Account is what we call it. The IRS actually calls it an Individual Retirement Arrangement, but we call it an Individual Retirement Account. So what it is, it's basically a trust. It's a retirement trust, individual retirement trust set up for the benefit of one person. Now, to qualify to make regular contributions, of course, you do have to have earned income. While the owner is alive, an IRA can only be titled in the name of an individual. Can a husband and wife have a joint IRA? No. Can an IRA ever be titled in the name of a trust? No. Because what does IRA stand for? Individual. Is a trust an individual? No. Does it file a tax return? It may, but it does not have earned income. It doesn't have a job. It doesn't get a W-2. And here's what I'm talking about right there. Somebody at the Holiday Inn threw a seminar about trust accounts. And all your customers went to this seminar, and they put the fear of God in them. Oh, if you die without a trust, all of your money is going to go to the state. So if you don't want that to happen, buy a trust. By the way, that's not true, but that's what a lot of them will try to market. So people will shell out a couple $1,000 for a trust, and then the next day they come in the bank and they want to change the title of all of their accounts, their checking, their savings, their CDs, their IRAs into the name of the trust. Can they do that? Well, they can change their checking, savings, and CDs, regular CDs, into the name of the trust. But can you put an IRA in the name of the trust? No, not while the owner's alive. He says, well, when I die, I want my money to be paid out according to what my trust says. No problem. We'll just make the trust the beneficiary of the IRA. Then after the owner dies, if the trust is named as beneficiary, you will set up what we call an inherited IRA titled the Doe Family Trust Beneficiary of John Doe IRA, after the owner dies, not while they're alive. I have seen where the IRS has ruled it's an immediate taxable distribution if you take the IRA title out of the individual name and put it in the trust name while the owner's alive. Okay, so when they do this IRA and they set up this plan, retirement money can be invested in all types of products, CD products, savings products, money markets, investments, annuities, mutual funds, the permissible, some types of investment, real estate, even some types of government coins. So the list of permissible investments is a long list of what you can put your retirement trust money into. But each investment at the same bank should not be its own trust unless you're not doing it right. And we'll talk about that in a minute when we get into the forms. Whenever anybody makes a contribution to an IRA, it's a deposit that should be reported to the IRS. Now, a lot of banks are not doing contribution forms when people bring money and put them in IRAs. I really do recommend that. Or at the very least, on the check, it should say what kind of plan it's going into, what kind of contribution it is, and if it's a regular contribution, what tax year does it apply to? Because don't forget, at this point, between January 1st and April 15th, when a customer comes in to do a regular contribution to a traditional Roth IRA, they could be making it for 2013 or 2014. You have to ask them which year they want it to apply to, because that affects your coding to the IRS, whether it's a current year or a prior year contribution, and it affects which year's